Home buyers, avoid these common mistakes after applying for a mortgage. If you're getting ready to buy a home, it's exciting to jump a few steps ahead and think about moving in and making it your own. That's fine. But before you get too far down the emotional path, there are key things to remember when you apply for your mortgage and even before you finalize the purchase. Here's a list of things to consider. Don't deposit large sums of cash. Lenders need to source your money, and cash isn't easily traceable. So before you deposit any cash into your accounts, discuss the proper way to document your transactions with your loan officer. Don't make any large purchases. It's not just home-related purchases that could disqualify you from your loan. Any large purchases can be red flags for lenders. People with new debt have higher debt-to-income ratio. And since higher ratios make for riskier loans, borrowers may no longer qualify for their mortgage. So resist the temptation to make any large purchases, including appliances and furniture. Don't co-sign loans for anyone. When you co-sign for a loan, you're making yourself accountable for that loan's success and repayment. And with that obligation comes higher debt-to-income ratio as well. Even if you promise you won't be the one making those payments, your lender will have to count them against you. Don't switch bank accounts. Lenders need to track and source your assets, and that task is much easier when there's consistency among your accounts. So before you transfer any money, speak with your loan officer. Don't apply for a new credit. It doesn't matter whether it's a new car or a new credit card. When your credit report is run by organizations in multiple financial channels, mortgage, credit card, auto, etc., it will have an impact on your FICO score. Lower credit score can determine your interest rate and possibly even your eligibility for approval. Don't close any accounts. Many buyers believe that reducing their available credit makes them appear less risky and more likely to be approved. This isn't true. A major component influencing your credit score is the depth and length of your credit history. Not just payment track record, but also your usage of credit as a percentage of available credit. So closing accounts might have a negative impact on those two components of your credit score.